In India, there are more than 3,500 different mutual funds available for investment. How is it possible for a common man just like you and me to understand which mutual fund should I select? Moreover, if you just do a Google search or even on YouTube when you search, you will get hundreds of videos talking about the best mutual fund for 2022, best mutual fund for 2023, and likewise, there are many influencers. Even I might even come up with a video for the best mutual fund of 2024 or 25 or as and when the time progresses. But the problem over here is there are so many mutual fund schemes available. Which one is the best suitable for you? So that's why in this video, I'm going to highlight and explain you what are the steps you need to take care when understanding and selecting a mutual fund. I'm not going to advise which are the mutual funds because that would be making a video which will give me more views rather, I would say. But it will ultimately not be in your benefit. You will never be able to select the mutual fund by yourself. So I'm going to explain in detail about some elements when it comes to understanding the mutual funds. So if you see this news article, this is again coming from a very big news channel. They are saying that if you look at this line, that mutual funds are not that easy in order to select, and moreover you require an advisory. So everywhere it has been portrayed that to select any mutual fund or to invest in any mutual fund, you need a financial expertise. So as we move, it is very important for us to understand what is the history of the mutual fund, because there are some key learning points that you need to take away as an investor to understand from the history. So in 1963, Government of India launched its first ever mutual fund called as Unit Trust of India. It launched the fund by the name of US 64. There were more than 10 million investors who actively invested more than 6,000 crore in this mutual fund. It is very clear that for this fund, there was no competition, it being a first mutual fund. This is when the real issue actually started in this mutual fund. Because of this stock market fall, the unit value of this mutual fund fell down from rupees 10 to rupees 6. That was more than 40% decline in the valuation of this mutual fund. So all these big financial institutions such as IDBI Bank, Madhavpura, LIC, they had their investment in this first mutual fund of India because it was first, everyone invested into that. Ultimately, because of this fall down, they started to withdrawing their funds and there was a redemption request which was put on hold. So government finally had to come out with their own bailout package of 3,300 crore in order to keep this UTI fund floating in the market and in order to safeguard the economy. Now, the thing is, all these investors, more than 2 crore investors who had actually invested in this mutual fund for a valuation of 6,000 crore, this all amount was at stake. Eventually, everyone got their money back because of this bailout package. Now, the second phase actually started from 1987 onwards. In that 5 years, which is from 87 to 1993, many public institutions as well. So far, it was only government who came up with their first mutual fund. Thereafter, all those public institutions such as SBI, they came up with their own mutual fund. Canara Bank in 1987 came up with their own mutual fund. Bank of Baroda, Bank of India, LIC, they all came up with their own mutual funds as a public sector mutual funds. So mutual funds saw a huge growth in its own asset under management. Now, what is asset under management? Simply that if I am managing, say, a portfolio of 5-10 different people, they are giving me their money and the portfolio size is 50 lakh. So I will say my assets under management is 50 lakh. Likewise, for all the mutual funds in the mutual fund industry, the asset under management in the period of 1963 was 6,000 crore. 20 years thereafter, the asset under management went up to 47,000 crore. That was more than 7 times of growth in the mutual fund industry, which it had seen in just 2 decades of time frame. That's a period where every individuals started investing. Even you must have heard about the names such as Rakesh Jhunjhunwala, Radhakrishna Damani. They all went very active because that was a very good growing phase. So you can imagine that industry is growing 7 times in just two decades. That's the biggest growth that you could ever see when it comes to finance or a mutual fund industry. So all started investing and everyone saw a good growth in this mutual fund thereafter. So in this phase of 1992 and 1993, which was the second phase of mutual fund called as, government formed its own LPG reform, which is liberalization, privatization and globalization, in a way to rebuild the entire economy so that Indian economy could grow. And in this same time period, government also issued a policy which enabled private players to launch their own mutual fund. So all of these private companies, private banks such as Kotak Mahindra Bank, ICICI Bank, then HDFC Bank, they all came up with their own mutual fund. In that same period, government also formed a body called as SEBI, whom we know now as a Securities Exchange Board of India. So they was formed in order to regulate the financial market, and the mutual fund size eventually grew to more than 1,21,000 crore from 6,000 crore in this 3 years of time frame. So you see, it grew from 6,000 to 42,000, 7 times growth in 2 years, but thereafter it saw equivalent growth of 7 times in just 10 years. So the mutual fund industry itself was aggressively growing in that period. So the Indian mutual fund history is not that old. It is just 20 to 30 years old. So even if you are like 30-year-old by this year of 2022-23, I would say that the industry itself is just 2 decades old, which is just 20 years old. You still have a long way to go. So if you're not investing in mutual fund or not investing in the market at all, it is the best time for you to consider this point. Now, why am I telling you all this story of the past historical about mutual funds? There are 2 reasons to that. Number 1 reason is mutual fund can go down. Mutual fund investments can go down. Your returns could be negative. So there is a quote always at the end of the mutual funds that mutual funds are subjected to market risk. It is not to be taken lightly because they are very serious that mutual funds can give you negative return. Now I'm not scaring you. There are ways in which you should be investing, and I'm going to disclose about that base strategy about which applies to all the mutual fund in this video. That's a number 1 reason. Number 2 reason is mutual funds can never go zero. It can go negative for a shorter period of time, but it will certainly not go zero. Why it will not go zero? The thing to understand is, where are mutual funds investing? Mutual funds are all investing in companies in which you and me are working. It is investing in the economy, the Indian economy, which is ultimately growing. So any of your mutual funds can never go zero. That is for sure. Yes, it might go negative for a smaller period of time, but that's about how your investment strategy is and how you select that mutual fund. So let's get started with this video where I'm going to explain an overview about what is mutual fund, and I will even disclose one strategy that's the base strategy. You apply any further metric on top of that may or may not work, but this strategy which I'm going to disclose will certainly work in any mutual fund. Let's try to understand the basic meaning of mutual fund at first. Now, आपको mutual fund का meaning definition definitely मालूम है, but in order to create a base of our understanding and for the further part of the video, let's quickly go through it. So what is mutual fund? Mutual fund nothing simply means that every individual will pool out their money to a company. Let's say you and me, we have formed our company called as our mutual fund. I'm not taking any mutual fund name over here. So all of these different individuals, they have started to giving their own capital money to us in order to invest in the equity market. So we will take a pool of money from different individuals. We will invest this money in a lump sum and on a collective basis on different stocks which are listed on stock market, and give them a specific unit value, which is also called as net asset value, which is the NAV of that mutual funds. So they have their own different formula in which they would compute depending upon the different exposure of the money into these different asset classes. They will derive with their own unit value. So आपको उस mutual fund का एक specific share मिलता है, which is that NAV, and you will keep track of this NAV which belongs to you specifically. Ultimately, the money goes to these different stocks. That's a mutual fund way of investing in the stock market. But if you had to directly invest your money, say हम दोनों को, आपको और मुझे directly रिलायंस में या फिर डायरेक्टली ICICI में या फिर HDFC में इन सब शेयर्स में इन्वेस्ट करना है, तो उस केस में वी कैन फॉलो अ डायरेक्ट इन्वेस्टमेंट अप्रोच वेयर वी डोंट गिव अवर मनी टू म्यूचुअल फंड, वी डायरेक्टली इन्वेस्ट इन दोज डिफरेंट स्टॉक्स ओवर हियर. Let me know in the comment below. I have written one name over here which is Avenue. Can you tell me which stock it belongs and it belongs to which company? I'm very sure you know about it. If not, then you have certainly got an experience of their very renowned brand. I'll not name them. Let me know in the comment below. I'll be interested to know whether आपको वो मालूम है या नहीं है. So just as a curiosity exercise, let me know in the comment below. So that's about mutual fund. Now, mutual fund को selection करने के criteria, there are 4 key things that you need to consider when selecting any mutual fund. The 4 key things are, first is a type of mutual fund, and again we will go into the details of each of them. The first is the type of mutual fund. Second is the method of mutual fund, like which method you are selecting to invest into that mutual fund. There are two methods. I will talk about them. Third is the expenses associated for you when you invest your money in the mutual fund. These are three basic and primary things which you need to figure out and consider when investing in this mutual fund. And I will again go into the details of each of these things. The last is the most important thing, which is the strategy of that mutual fund, which drives ultimately the return of that mutual fund and which drives the return in your portfolio. So watch it till end. I will quickly cover about these three things and then we will go into the strategy discussion of that mutual fund. And I will give you relevant data points and I will also give you some proofs about some of the mutual funds, how they disclose their strategy to you and what is it that you need to consider. बस इसके अलावा you don't really require anything when it comes to identifying and selecting a mutual fund. You can very well select the mutual funds by yourself. So let's get started with these four key things. So starting with the first type, which is types of mutual fund. There are five broader types of mutual funds, I would say. The number one is equity. Then we have debt funds. Third is hybrid funds. Fourth is solution-oriented funds. And then we have some other category of funds. So we will talk about each of them now. So talking about, when I say about equity market, equity funds, that means fund houses which are investing. Now, what are these fund houses? These are companies, as we just saw a while back. We are giving all our money to this fund house, this company, who is investing in the stocks which are listed on the stock exchanges. That's the primary destination of where our money goes. That means it goes to the companies which are listed on the stock exchange. So it could be companies such as ICICI, Avenue Supermarket, then Ashok Leyland and whatnot. Again, these are not recommendations, but yes, these are all listed companies in which the equity fund houses investments goes. Such as, so equity fund houses could be like a large cap, mid cap, small cap. They all invest in this different proportion in this different market cap of these companies. So that's what equity mutual fund means. Debt mutual fund means they are investing in bonds. Now bonds could be public bonds or private bonds as well. Now what is the basic definition of bond over here? Understand that when a company, say you are running a company, you want a loan. You want money to run its day-to-day operations, right? So in that case, you have only two options. The first option could be you could go to a bank, take a loan from them, which will act as a debt. In that case, you have to give some committed interest payout to the bank. The second option for you could be you could come to individuals like me and many others and give a corporate bond of yourself and you will guarantee some percentage premium, percentage return on this bond. So you will take a money from different individuals in order to run your business. IPO में पैसे लिए जाते हैं, yes, but after that you can issue more shares in order to get money. But यहाँ पे bond के केस में you are not giving shareholding to any individual. You are simply taking a loan, but not from bank, but from many individuals. That means you are taking loan from public. So all the mutual funds who are giving this money to these different companies, that means they are investing in these bonds. That's the second category of mutual fund, which is called as debt mutual fund. Third is hybrid, which is a mix of equity and debt mutual fund. So companies, fund houses, when they decide to park some money in equity, because equity are little riskier investment compared to bond, because bonds are more guaranteed kind of investments. So that kind of mutual fund houses are also called as hybrid mutual fund. Now the primary difference, if I have to highlight between equity and debt, is the debt gives you less ROI compared to equity mutual fund. That's why people often prefer to invest in an equity mutual fund for that per se. The third one is solution oriented. So solution oriented, you can call it is as any mutual fund which is concentrated towards some specific solution. So solution could be, say, your children's education, right? Then some healthcare or welfare kind of thing where you are investing for some specific purpose. So there is a specific solution or a key requirement of your life for which you are investing in this mutual fund, and they will accordingly invest in different securities, different government bonds. But the investment philosophy is very safeguarded over there. The returns are very less, but at the end the aim is to guarantee you some return over a period of time. So that's a solution oriented mutual fund. Third is the exchange traded funds, the fund of funds. So what is exchange traded fund? So if I have to talk about exchange traded funds quickly over here, if you just pull out the name of top 50 companies which are listed by the market cap, that means उनकी जितनी भी valuation है कंपनी में listed stock exchanges पे, top 50 companies का अगर हम pool बनाएंगे, So there is an index formed for that, which we call it as a Nifty. That means National Stock Exchange, first 50 companies over here. So these are 50 companies. So when you say index, that means you are investing in this top 50 companies. That means you are investing in that index of Nifty itself. So that's what this exchange traded fund means. It is again going very viral and it is increasing. India is still way behind when it comes to investing in exchange traded fund compared to developed economies. I can again make a different video explaining you in depth about exchange traded fund, and I will be making a video. So do subscribe, in fact you haven't. So that's about the type of mutual fund. The next thing that I will talk now about is expense ratio and different methods of investment. So talking about the methods of investment, there are two methods in an ideal scenario in which you could invest, and these are the only two methods available. The number one is a direct way of investing. That means you as an individual directly go to the mutual fund company and you ask them to invest in the market. So for that, they will charge you some things, and I'll talk about expenses in this second section. And second method of investing in any mutual fund is indirect. That means you as an individual over here, you don't go to a mutual fund directly. You go to a broker in between, and that broker company advises you as a financial advisor, and then they will invest in this mutual fund for you. So this broker could be several applications, several digital service provider companies, digital financial services provider companies, fintech companies, where they are taking your pool of money and they are investing in this mutual fund. But that's an indirect way of investing, and at the end the money goes to the market. Now अभी आप खुद ही बताओ, अगर आपको प्रॉपर्टी खरीदनी है, so there are two ways for you to deal in that property. The number one way is direct, whereby you go directly to the landlord, speak with them, negotiate and sign the deal with them. The second way could be you approach them via a broker. Now definitely there are advantages when it comes to approaching the landlord by broker, because you get to know about the market, you know about different properties which are available in this area, and accordingly you invest. But with that comes a specific cost of that broker, which is called as expense for that broker, not expense ratio for that mutual fund, but expenses only for that broker. So there is a different cost involved when you invest directly with a mutual fund and you invest via broker. Certainly you are very well mature enough to understand that the cost to go via broker is always high, and that's what is meant by expense ratio here. So when we talk about expense ratio, there are expense ratios which is associated with a mutual fund and the fund houses. Why? Because they are managing your money. They have a resource and they have a team member who are working, who are doing the research in the market, who are attending the con calls of different and attending several AGMs, the general meetings of different listed companies, and by way of which they are selecting these stocks in order to have it managed for you. So they are going to certainly charge some money for you. But what is to note is that in the direct way of investment, that is this way of investment, if say they are charging you 0.5, then in an indirect way of investment, which is this way of investment, you will be having a charge of maybe 1% or more than that. Why? Because there is a broker in between to whom you have to, the mutual fund houses have to pay the money to this broker in order to bring that client to them. So that's why, that's a first primary difference when it comes to an expense ratio between direct and indirect way. So conclusion, in indirect investment, your expense ratio is less, and in indirect, that is indirectly going via broker, your expense ratios is very high. The question rather we should ask is, why these fund houses are relying on an expense ratio model and not on profit sharing? Ultimately, if they are working in a favor for investors, and that's what they try to present every time in their presentation and every emails or marketing promotions that they do, then why are they not working on a profit sharing model? Now, this is a question that you as an individual investor should always ask the mutual fund. The simple answer to that is, a focus of a mutual fund is to run a business. Ultimately, their company, their fund house should be profitable. If they rely on profit sharing, and if the market goes down, if they don't perform, there are employees who are working in their company in order to build this portfolio, research these stocks. They have to pay them the salary. There are managers to whom they have to pay a very hefty salary. So they always rely on the model of paying some percentage, or rather charging some percentage of the total portfolio that you want them to manage for you. So that's why they always focus on expense ratio, and it is always in their favor. Why? Because if you try to understand that if a fund house, let's take an example, ICICI fund house. Now there is nothing to talk about, much to say against ICICI, but simply to take an example, say they have started with a fund house, they have come up with a new fund offer, which is also called as NFO, and they have started with a very small expense ratio. Eventually, when this fund house, whatever assets they are managing, let's say there are 50 people who invested 4 to 5 lakh rupees each, so there is somewhere around 2 crore is what they are managing at this present time. A year after, their fund house is very likely to grow because the investment returns are very good. It's very small percentage or small amount that they had to manage. It's very easy for them to take higher risk and show them very good result in the beginning, and that's what the fund houses always do. Over a period of time, their asset under management increases, and you will see several fund houses talking and managing about, I don't know, thousands of crores of assets. So you can imagine a small percentage of that entire asset under management is being charged and earned by them as their sales, as their revenue. To show you how profitable these fund houses are, let's take an example of this ICICI AMC over here. As you can see, their profit after tax has grown from 11.79 billion rupee to 14.36 billion rupee. And understand that this is not 14 crore, it is 14 billion rupee. Moreover, and the same thing is presented by them in their income statement. So the thing to understand is that mutual funds are always working for themselves first and then for their investors. None of the mutual fund works in the favor of investors because they are not on a profit sharing model. They don't earn when you earn, they earn irrespective of whether you earn or not. That is why when selecting in a mutual fund, you should be very strict, and there should be some specific key strict strategy that you need to follow, and that is what I'm going to disclose now. So talking on the strategy part. The mutual fund houses and the fund managers are not going to sit with you and tell you, okay, Ajinkya, this is where I am investing. Do you really liking this or not? Invest with me. These are the stocks in which I am going to invest in the coming time. So you invest and I will invest that money in those stocks. No, they are not even going to disclose you their own tools and techniques that they use, what kind of indicators they are using, what are the softwares they are using, what kind of analytics they are performing in order to filter the stocks, what kind of decision making criteria that they are doing, what kind of board meeting they are doing. No, they are not going to reveal you any of those information, but what certainly they can reveal you is what stocks they are investing, which sector they are investing, and what is their investment objective. So if you take an example, which I would like to take over here, is of Parag Parikh. They have clearly stated their investing objective is they are investing in the Indian equity market and as well as in the foreign equity market. Moreover, if you look at the industry allocation, they will even outline you in a straightaway manner all the industries in which they are investing into. For example, for Parag Parikh, if you see this over here, they are very explicitly highlighting the industries in which they are investing. So if you see this over here, they are specifying that 15% is invested, majority of their investment is into the finance industry. Next is IT, then cash, they are holding some cash with them, and even banks. So collectively, if you make a sum of this, 50% of the fund exposure has in this industry. Vis-a-vis, now let's compare this data with ICICI Prudential Mutual Fund. ICICI is investing majorly into large cap. That's what they are highlighting over here. That's a large cap investment for this specific fund. ICICI does has different cap mutual funds as well. But for a use case of comparing one large cap to another, we have taken a large cap example. Now they are also highlighting top sectors in which they are investing. Forget about the stocks. Sectors are more important when you analyze any mutual fund. So the top sectors in which they are investing are banks, IT, petroleum, automobile and construction. This is also collectively making somewhere around 55% of their investment in these top 5 sectors. Now if you compare Parag Parikh with ICICI, yes, Parag Parikh is investing in bank, both are common. They both are investing in IT. Parag Parikh is holding some cash and Parag Parikh is investing in finance industry. Whereas in ICICI Prudential, they are investing diversely in petroleum, automobiles and construction. These are unique and these are different than Parag Parikh. Now, if you feel by any mean, these 3 industries, which is petroleum products, automobile and construction, which you will see in every news channel, they will comment which are the industries likely to grow. You just simply Google that petroleum product industry, is it likely to grow? You will get thousands of articles and news published about it. If you feel that these 3 industries will grow compared to the industries in which Parag Parikh is investing, the investment objective should be you should invest in ICICI Prudential Blue Chip Fund. Now, this is not an investment advice, this is simply a strategy, and that's a hack and that's a crux of any mutual fund. Irrespective of which stocks it is investing in that specific industry, it does not matter. Ultimately, they have their own research team, they have their basic fundamentals set out that they will invest in a moderate and a good enough stock, not risking too high and not even taking a minimal risk. So they take a moderate risk so that the stock grows, and if that industry has to grow, whichever hook and corner of that stock be, if it has any relation with that industry, it will grow. That's the method and that's a strategy of how you should be selecting any mutual fund. I will leave you this video, if you are watching till here, a pro tip that when any new fund offer comes, when the mutual fund size is very small, it's very easy for them and it is very easy for them to even give a higher return. So that's why any funds which you see are smaller in size, they will in a way give you a better return compared to fund which has a huge amount of asset to be managed. It's difficult to manage a high amount of asset. This is a pro tip, again not a recommendation of any mutual fund, but this is how you should be considering before investing and selecting any mutual fund. This is Ajinkya. See you in the next video, guys. Good luck.